Imagine this. You're standing in front of an overwhelming wall of ETFs, each claiming to be the perfect investment. Dividend ETFs, growth ETFs, sector ETFs. How do you even start? If you're feeling lost in the maze of options, you're not alone. But what if I told you that all you really need are 3 ETFs? That's it. 3. This is where most investors get it wrong. They chase the hottest funds or over-diversify, thinking it's the safest bet. The truth? Simplicity wins. The right 3 ETFs can give you growth, stability, and broad market exposure without the noise. And here's the kicker. You don't need to guess. I've already done the heavy lifting for you. In this video, I'll show you how to structure a powerful 3 ETF portfolio designed to grow your wealth and protect you from unnecessary risks. No more guessing games, no more FOMO-driven decisions, just a strategy that works. Stick around, because by the end, you'll not only know what ETFs to choose, but why they're the ultimate combination for your financial future. The world of investing can feel like navigating a maze. You're bombarded with advice to buy this ETF, dump that one, or chase whatever sector is trending. It's overwhelming. And let's face it, the more complicated it gets, the easier it is to make mistakes. That's why today, I'm here to cut through the noise and deliver a strategy that's simple, effective, and proven. A 3 ETF portfolio that covers all the bases. Here's why this video matters. So many investors get caught up in past performance, swapping ETFs because one grew faster last year, or chasing niche funds that seem hot. But the truth is, your portfolio isn't about what did well yesterday. It's about what will build sustainable growth for tomorrow. That's why I developed this 3 ETF strategy, to help you focus on what actually works. If you've ever felt overwhelmed by all the choices or second-guessed your investments, this video is for you. I'm going to break down how you can create a balanced portfolio with just 3 funds. No guesswork, no fluff, just clear, actionable advice. By the end of this video, you'll not only know how to set up this portfolio, but also how to customize it based on your age, goals, and risk tolerance. I've poured years of experience into perfecting this, so you can skip the trial and error and get straight to building your financial future. Serious about investing? Then you need the right tools. TradingView gives you advanced charts, price alerts, and real-time data, all in one place. Whether you're tracking ETFs, stocks, or crypto, stay ahead of the game. Check the link in the description. Stability with dividend ETFs. Every great structure starts with a solid foundation, and in investing, that foundation is stability. This is where dividend ETFs come into play. These funds aren't just about collecting dividends. They're about providing a buffer against the wild swings of the market. Think of them as the steady ship in an ocean full of unpredictable waves. Why is stability so important? Because the less volatile your portfolio is, the better you can sleep at night during market downturns. When the market is in freefall, a solid dividend-focused ETF tends to drop less than growth or sector funds. This makes it the perfect anchor for your portfolio. Take SCHD, Schwab US Dividend Equity ETF, for example. It's one of the top choices for a reason. SCHD is packed with high-quality dividend-paying companies that have a track record of consistency and reliability. But here's the catch. Dividend ETFs aren't just about the payouts. They're about consistency. You want a fund that holds its ground even when the market gets rocky. Now let's compare SCHD to another solid option, VYM, Vanguard High Dividend Yield ETF. While VYM might not have the same sector concentration as SCHD, it offers a broader mix of companies and focuses on delivering steady returns through dividends. The key is understanding that both of these ETFs reduce risk while still contributing to the overall growth of your portfolio. Here's a real-life example. Imagine the market drops 20%. A solid dividend ETF like SCHD or VYM might only drop 10 to 12%, giving you time to rebalance and recover. Without this stable foundation, you'd be at the mercy of the market's wild swings. But there's a common misconception I need to clear up. Some investors think the dividend category should also offer explosive growth. That's not its role. The goal here is safety and lower volatility. If you're chasing double-digit returns, you're in the wrong section of the portfolio. So how much of your portfolio should go into dividend ETFs? This depends on your age and risk tolerance. If you're younger, maybe 20-25% of your portfolio goes here. If you're closer to retirement, you might lean heavier into this category, around 40%. It's all about balance. Quick tip, don't get too caught up in choosing between SCHD and VYM. Both track strong indexes with similar goals. The important thing is understanding their purpose, to keep your portfolio steady while the other sections do the heavy lifting. In the next section, we'll dive into the exciting part of the portfolio, growth ETFs, the engine that drives your returns. Want to invest globally without losing money on currency conversion? Wise gives you the real exchange rate with low fees, so more of your money goes into investments. Sign up today. Link in the description. Now that we've built the foundation with dividend ETFs, it's time to focus on the portfolio's engine, growth ETFs. This is where your portfolio picks up speed and generates significant long-term returns. Growth ETFs are designed to capture companies with high potential for future profits, making them essential for building wealth. Think of growth ETFs as the rocket fuel for your investments. They're higher risk than dividend ETFs, but they're also the reason your portfolio can outperform over decades. However, not all growth ETFs are created equal. Picking the right ones and knowing how to use them wisely can make or break your strategy. Two of the most popular growth ETFs are QQQ, Invesco QQQ Trust, and SCHG, Schwab US Large Cap Growth ETF. Let's start with QQQ, which tracks the NASDAQ 100. It's a powerhouse of tech giants like Apple, Microsoft, and Tesla, offering exposure to some of the fastest-growing companies in the world. Over the past decade, QQQ has delivered stellar returns, largely fueled by the rapid rise of technology stocks. But here's where it gets tricky. Growth ETFs like QQQ often get confused with specialty or sector funds, such as SMH, VanEck Semiconductor ETF. SMH focuses on the semiconductor industry, which has seen explosive growth thanks to AI and tech advancements. While its returns have been impressive, over 276% in the last 5 years, this narrow focus makes it risky. Why? Because a single downturn in the semiconductor market could wipe out a significant portion of its value. That's why a broad growth ETF like QQQ or SCHG is generally a smarter choice. SCHG, for example, also leans heavily into tech, but spreads risk across other growth sectors like healthcare and consumer discretionary. This diversification makes it less volatile than a niche fund like SMH, while still capturing strong growth. Here's a quick story to illustrate the risks of chasing sector funds. During the early 2000s, tech stocks were the golden ticket until the dot-com bubble burst. Investors who were overexposed to niche tech funds saw their portfolios plummet, while those who diversified across broader growth ETFs were able to recover faster. The lesson? Chasing trends can be dangerous, but a well-balanced growth ETF is built to weather storms. So, how do you incorporate growth ETFs into your portfolio? The key is balance. Let's say you decide to allocate 30% of your portfolio to growth. You might put 25% into QQQ or SCHG for broad exposure and save 5% for something higher risk, like SMH if you're feeling adventurous. This way, you capture potential gains without overexposing yourself to unnecessary risk. Another common mistake is constantly switching growth ETFs based on recent performance. Remember, investing is about the future, not the past. Just because SMH outperformed QQQ last year doesn't mean it will continue to do so. A well-diversified growth ETF allows you to stay the course without getting caught up in hype cycles. Quick tip, think of growth ETFs as the accelerator for your portfolio. They're designed to generate returns, but they should never overshadow the stability provided by your dividend and broad market ETFs. In the next section, we'll tie everything together with the backbone of your portfolio, broad market ETFs. These funds give you exposure to the entire market and ensure your portfolio stays balanced over the long term. We've covered the foundation with dividend ETFs and the engine with growth ETFs. Now it's time for the backbone of your portfolio, broad market ETFs. These funds are the glue that holds everything together, giving you exposure to the entire US stock market or its key segments. Broad market ETFs are designed to track either the S&P 500 or the total US stock market. They provide a solid mix of large, medium, and small cap companies, making them essential for long-term growth. Unlike niche funds or growth ETFs, broad market funds aim for consistency, delivering returns that closely match overall market performance. Let's start with two of the most popular choices: VTI, Vanguard Total Stock Market ETF, and VOO, Vanguard S&P 500 ETF. VTI offers exposure to over 4,000 US companies, while VOO focuses on the top 500 large-cap companies in the S&P 500. Both are excellent options, but there are subtle differences to consider. VTI provides broader exposure, including mid-cap and small-cap stocks, which can deliver higher growth during bull markets. On the other hand, VOO sticks to large-cap companies, which tend to be more stable but slightly less growth-oriented. Choosing between them depends on your personal preference and investment goals. Now here's a common question. Should you go with VOO or a similar ETF like SPLG, SPDR Portfolio S&P 500 ETF? Both track the same index, but SPLG often has a slightly lower expense ratio and a lower share price, making it more accessible for new investors. Ultimately, the choice doesn't matter much. They perform almost identically. The key is to pick one and stick with it. Here's why broad market ETFs are so critical. They provide the diversification needed to protect your portfolio from the ups and downs of individual sectors. For example, during the 2020 pandemic, tech stocks soared, but sectors like energy and retail lagged behind. A broad market ETF balanced these extremes, ensuring steady growth without wild swings. Imagine building your portfolio without a broad market ETF. You'd either have to buy dozens of individual stocks to replicate the same diversification or risk overexposing yourself to a few companies. With ETFs like VTI or VOO, you get instant exposure to thousands of companies with a single investment. It's simple, effective, and proven. So how much of your portfolio should go into broad market ETFs? For most investors, this section should make up the largest slice, around 40 to 60%, depending on your age and risk tolerance. Younger investors might lean slightly more toward growth ETFs, while older investors may prefer the stability of dividend ETFs and broad market funds. Quick tip: don't overcomplicate this section. Whether you choose VTI, VOO, or SPLG, the goal is the same: to capture the overall performance of the US stock market. The important thing is to stay consistent and avoid switching funds based on short-term trends. With your portfolio now balanced between dividend, growth, and broad market ETFs, you've got a setup that's designed for success. But there's one final step: taking action. Now that you know how to build the ultimate 3 ETF portfolio with SCHD, QQQ, and VTI, it's time to put this strategy into action. This simple combination gives you stability, growth, and broad market exposure, all you need for long-term success. For more insights, check out my video on the 6 best ETFs for 2025 or my guide on identifying stocks that could 10x in the next decade.